In 2026, the market has a stability paradox. On the surface, the indexes look strong, driven by the AI revolution. But underneath, the middle class feels a tectonic shift. We are in an era of sticky inflation and high interest rates that have rendered the old investment playbooks obsolete. Hi there, and welcome to Principal and Profit. We help individuals understand how to build wealth through value investment guidelines that ensure security of your principal value while generating inflation-beating profits. Now, if you just bought the dip in a concentrated tech fund in 2025, you might be up, but you're also one bad earnings report away from a 20% drawdown. Today, we are building a fortress portfolio. This is not about beating the market for 1 week. It's about the evidence-based construction of a portfolio that remains steady through bubbles, bulls, and bears. We're going to look at the math of why the 60-40 rule failed us in 2022, why bonds are finally legal again in 2026, and how to use REITs and anti-fragile assets to protect your purchasing power. The core of any portfolio is the growth engine, which are its equities. But in 2026, you cannot just buy a broad index and hope for the best. Why? Because market concentration is at a 50-year high. If 3 companies in Silicon Valley have a bad quarter, your entire diversified index fund tanks. To fix this, we use the quality factor. We aren't looking for cheap stocks, we're looking for fortress balance sheets. In 2026, we prioritize companies with low debt-to-equity ratios and high free cash flow. Here is a breakdown of our 2026 selection aimed at stability during these uncertain times in the market. Firstly, we have opted to allocate 60% of our portfolio value to ETFs that track the global stock market and not just a singular economy. An example of such an ETF includes the MSCI World Quality ETF, which filters for companies that actually make money, not just those that burn vested capital on AI hype. Secondly, we have decided to allocate 15% of our portfolio value to emerging international markets, so that not only are we protected from a US market crash, but we have also minimized losses from the dollar depreciating in value. With US valuations at a PE ratio of nearly 22 times, 2026 data shows that international markets, particularly in Asia and even in South Africa, are trading at a significant discount. By diversifying geographically and through factors, we reduce our systemic risk. For the last decade, bonds were dead money. In 2022, we saw the worst bond market in 150 years because rates rose from zero. But here in 2026, the math has flipped. With the Federal Reserve holding rates at a new normal of 3.5 to 3.75%, bonds are finally doing their job again. They provide income and inverse correlation. You're probably asking yourself, why would this work? Well, here's why this works. If a bear market hits in 2026, central banks will likely cut rates to stimulate the economy. When rates drop, your bond prices go up. This is the shock absorber that keeps your total portfolio value from cratering when the equity engine stalls. In the previous video, we talked about the middle-class trap of physical property, such as car financing, which is generally accompanied by the high taxes, the maintenance costs, insurance premium costs, and the lack of liquidity that comes with that. The link to the video is in the description below. In a fortress portfolio, we want the benefits of property without the anchors. In 2026, REITs, real estate investment trusts, are making a massive comeback. After being crushed by high rates in 2024, they have restructured their debt. This is the logic that we are applying. REITs own the infrastructure of the future: data centers, logistics hubs for e-commerce, and high-quality retail. This is the mathematics that we're applying. Many US REITs are currently yielding 4% in dividend income, and REITs in foreign market, such as the South African market, are posting yields between 7 to 10%, which is an impressive figure. Unlike a stock, where the value is based on future earnings, or hope, A REIT's value is backed by hard assets and lease agreements. This provides a floor during market bubbles. When the AI bubble of 2025 corrected, REITs remained stable because people still needed to pay rent for their servers and their warehouses. The final piece of a stable portfolio is what Nassim Taleb calls antifragility. This is the 10% of your portfolio that actually benefits from chaos. In 2026, this means that we are dedicating 5% of our portfolio to gold and commodities. This is not because we're preppers, but because gold has a zero correlation with stocks. In every bear market since 1970, gold has acted as a safe haven. Secondly, we have decided to allocate 5% towards managed futures or tail risk hedging ETFs. These are specialized investment vehicles designed to protect portfolios against extreme, rare market downturns or black swan events by utilizing options-based strategies or volatility-linked instruments. Think of this as your insurance premium. You hope you never need it, but when the market drops 10% in a week due to a geopolitical shock, this 10% of your portfolio can surge by 50%, keeping your total balance flat while everyone else is panicking. So here is your 2026 Fortress build. Keep 45% invested in quality equities. This is the engine. Then dedicate 25% to intermediate bonds. This is your shock absorber. Allocate 20% to REITs or real assets. This shields your portfolio against inflation. Then lastly, position 10% of your portfolio to gold or anti-fragile commodities. This will be your chaos insurance. This portfolio is designed to maximize your Sharpe ratio, which measures your return per unit of risk. By spreading our risk across these 4 uncorrelated buckets, we significantly lower our risk without sacrificing too much return. This is how you survive a 2026 bear market with your sanity intact. Stability isn't a gift from the market. It's an engineering feat you perform on your own money. If you want to see the specific ETFs I use to build this quality engine, let me know in the comments. If this deep dive helped you see through the 2026 noise, hit like. Subscribe to stop being a victim of the middle-class trap and start becoming a Fortress investor. Share this with one person who is still holding a 100% tech portfolio. They'll thank you when the next volatility spike hits. I'll see you in the next one.